Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Let's go straight to the headlines. Subdued food prices cooled India's retail inflation to a 5-month low in the month of July. MSCI makes changes to its global standard index. Page Industries is the new entrant, while Vakrangi makes an exit. Strong demand and buoyant spreads led to Tata Steel's quarterly profit doubling in the June quarter. Sun Pharma may not necessarily share its subsidiaries Taro's ailments in the first quarter. Well, let's bring up the trade setup for the day. Looks like we'll have a start which is mixed bag, but maybe a tinge of green as well if the world markets were to be believed. There was uncertainty with a bit of a negative bias, but we ended about 0.5% to 0.25% at least for the US markets. Yes, Europe was a lot more affected and the European markets were down a lot more than what the US markets did, especially the DAX. But Asia is painting a mixed picture. Nikkei about 1% higher in trade, Shanghai 0.5%, Hang Seng about 2/4 or 0.75% in the red. The SGX Nifty pointing towards a flattish start in trade. So no big gyrations expected at the start of the trading day. And frankly, over the last couple of days, as per textbook, we've seen some bit of long unwinding happening both for the Nifty as well as the Nifty Bank predominantly. However, you have to say that volumes on the key indices remained low in the session yesterday, both on the cash market. I would say also on the FNO side, considering the kind of activity that was happening the last 2 or 3 days, FNO volumes were by and large in line. What happened yesterday was in the last 1 hour of trade, though, broader markets showed an even deeper correction, and the market breadth, which was anyways bad, worsened towards the close of trade. Flows the last 2 days from the FI side have been negative and DIs have hardly pumped in cash. So yesterday was about 550-600 crores of provisional outflow. Or day before yesterday, that is. Yesterday the number is at about 971 crores. Nothing too alarming, but we just started seeing FIs starting to put in money. The last 2 or 3 sessions, that seems to have turned around a little bit. What's to be watched today? I think crude and oil came off. There was a report of rising US stockpiles which added to demand fears, and all of that led to crude prices at least around midnight cooling off about 3.5% in trade. That should only augur well for select stocks and the market sentiment. The rupee, though, is a problem, very close to the psychologically important mark of 72. The dollar, 69.82 or thereabouts. And that's not something that would sit very well, 69.92, excuse me. So it's just a stone's throw away from the psychologically important mark of 70. That will be very, very important. If that gets taken out and taken out convincingly, then it'll be interesting to see what do some of the bond trader or the currency traders have to say. So watch out, all eyes frankly out on the rupee, and let's see if that stabilizes in the session today. And of course, we'll watch out for the MSCI changes and what happens to those. Darshan will dwell on it, so I'm not spending too much of time here. We'll talk about those in detail. But all of this is during the course of the day, or maybe the rupee is at 9 a.m., yes. But what about stocks at 9 or 9:15? The stocks that are likely to react to their numbers or news flow. Tata Steel is the big one. Again, we'll talk about that on First Word. But look at the others. There were some strong numbers given by Apex Frozen, Lemon Tree, Oracle Financial Services. Apex Frozen, the margins went up from 12.3 to 13.5%. So good margins there. The net profit for Lemon Tree was at 2.3 crores versus a loss of 2.4 crores. As well as for OFSS, the net profit was up about 70%. Margins expanded meaningfully on a quarter-on-quarter basis. This could well turn out to be the stock of the day. Let's wait and watch what happens there. Giving it competition would be Fine Organics, newly listed company, in which I'm dwelling on this a bit. Revenues were up 93% to 40 crores. Profit up 181%. At 37 crores versus 13 crores. Margins expanded meaningfully. We've been talking about how specialty chemical companies, Vinati is a case in point, they all have been doing well. I think it could be the day for Fine Organics in the session today. Let's wait and watch. It's not as liquid a stock as some of the others are, but could be an interesting one to monitor today. Max India in focus, Bain Capital. This is the Economic Times report, of course, but Bain Capital joins KKR in race for Max Healthcare. PE firms might buy about, or vying to buy about 47% stake in the Life Healthcare for $450 to $500 million. This is as per the Economic Times report, but all of this puts Max India firmly in focus today. Watch out for oil marketing companies. If the rupee were to weaken further yesterday, in large portion the OMCs were down because of what happened to the currency. Let's see if this further aids the weakness, or do we see the OMCs take heart from the fact that crude cooled off a little bit in the session yesterday. And last but not the least, a tiny tune, NCL Industries. HDFC Mutual Fund has acquired about 2.19% stake at 147 rupees. It'll be interesting to see what happens to this stock in the session today. So that's the stocks that you need to monitor, but let's tell you what's lined up on First Word today. We start off with Darshan, who takes us through the changes made to the MSCI index. One stock that's made it to the MSCI Global Standard Index is Page Industries, firmly in the jockey's seat. We'll talk about what's working for Page. A SEBI panel has proposed extending the consent mechanism to cover some other allegations. Jayashree Upadhyay will fill us in on the categories. We take a quick look at the latest inflation numbers, which have moved back closer to RBI's comfort zone. And we end First Word with a small slice of what Mark Mobius makes of the Turkish standoff. First piece on First Word today, MSCI has tweaked the constituents of its global benchmark indices, and a couple of Indian stocks have also found mention. Darshan Mehta is standing by with the additions and the deletions made. Darshan, very few changes made, but interesting ones.
Yeah, very few, and usually they have the small cap index has almost like 20 additions, 20 deletions, but this time very, very small. The big takeaway is that Page Industries, it's been a long time this was coming, and Page Industries is finally in it, and I believe you're also going to speak about Page Industries today. So Page Industry comes into the Global Standard Index. This is the bigger index out of it, and what goes out of this index is Vakrangi, given the fact that what all has happened, the underperformance, and MSCI had included Vakrangi last time around, given the fact that when the market cap was almost 50,000 crores. Now they're deleting it, but they're putting it in the small cap index. The change that happens is because Page Industries has moved from the small cap index to the large cap index, it gets deleted from the small cap index. The other notable change is Delta Corp. Delta Corp goes out of the small cap index. There's no reason why it is, because the stock price performance hasn't been that weird, but given the fact that the rise in share in the market cap of Page Industries, obviously Page Industries was supposed to be there. The changes will be effective as close of August 31st. What does this mean? As of now, there are no sales notes that have come out that indicate how much potential inflows or outflows will be, but expect potential a lot of inflows to come into Page Industries, because a lot of global funds, they map their holdings into how Page Industries, how the MSCI makes changes, because they can't track each and every individual company. So expect inflows to come into Page Industries and expect outflows. The other interesting part is the China index. So now MSCI will implement the second step of the inclusion of the China A shares now. Basically, their weightage will go in from 2.5% to 5%, which will mean that the weightage of China will go up, which will eventually mean that other emerging markets in India, the weightage will gradually come down because of the inclusion of the China A share this time around. So that's about it. Not too much changes, but expect Page Industries to react positively. Page, incidentally, ended at the highest point of the day in trade yesterday. It moved up gradually also in trade, so probably Page Industries will be in focus today.
Well, very interesting. Thanks, Darshan. Thanks for putting this into perspective. So yeah, usually there's a lot of stuff to talk about when it comes to the MSCI changes, rebalances, whatever you call it. This time around, not too much. Maybe Page in focus, and maybe we preempted this, but no, not really. We just looked at what the stock has done in the past. It was recently in news as well after retaining the jockey franchisee in India. But Page has been putting up an impressive show for quite a few quarters now. Let me just try and dwell on this for a bit. Why is it that Page, as a stock and as a business, is looking so impressive? Some statistics here. The 10-year CAGR returns for Page Industries, the stock price return is to the tune of 51%, point something, but 51% for the sake of rounding off. Now, the beauty is that revenues have grown 20%, but earnings have grown 30%, which means that they have expanded quite meaningfully over a 10-year period on their operational metrics, as a result of which they have been able to grow earnings faster. And then the market has expanded the P multiple at an even better clip, and which is why the stock price has given a 51% return. So you see the difference between the revenue growth versus the stock price return, and of course the earnings wedged out there in between. The last 2 years as well, you will see that the revenue growth was up 20%, the EBITDA growth was up 32%, recurring PAT about 35%, and volumes as the quantum of sales that they do of the pieces that they sell is about 11%. That's fairly decent for a company which is now the size of Page Industries. And they have done all of this over the last 2 years, 5 years, 7 years, while maintaining margins just shows the moat that they have around the business, that the numbers are moving up, sales are moving up, they're still able to hold on to these margins. Look at that picture. This is, I think, over the last 2 years, but if you look at the last 5 years as well, the margin picture for Page Industries, this is probably 3 years. If you look at the last 5 years as well, by and large, the margin picture has looked very, very impressive for Page Industries. So they've been able to hold their fort on the margin front as well, despite rising sales, which speaks about the kind of moat that they have. Now, I scanned through the annual report. There are 2 or 3 highlights that stood out for me individually. Inventory days have declined and declined meaningfully. There were 107 days in FY17 to 81 days in FY18. That's really, really impressive. Their outsourcing is up from less than 20% in FY17 to approximately 30% in FY18. And they've given a target of 40 to 50% outsourcing in the next 2 years. A lot of managements have been talking about how instead of having in-house costs, in order to better manage margins, they are outsourcing work. We've seen that happening with air cooler companies. We've seen that happening with air conditioning companies, and there are contract manufacturers which are firmly out there. Now we're seeing Page, the largest or the biggest by being a poster boy, also starting to do that in a meaningful way. So watch out for this number in particular. And some statistics which to my mind stood out for me. If you just look at what Page has done in FY18 in terms of total number of pieces sold, the number of pieces that they've sold is about 18 crores. Now just do the math out here. If a person, any one person, with an assumption that over a course of 12 months would not just buy one piece but would buy more than one piece, I've taken the number at about 6. You could take the number at 4, 5, 6, whatever the case may be, but working with that assumption that one person would, including innerwear, socks, etc., 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 would buy about 5 or 6 pieces from Page throughout the year, Page has catered to only 3 crore people, and which is effectively what? Less than 3% of the population. So we talk about how large this company has become. It's still scratching the surface as far as the reach of the products to the country goes. So it just shows the runway of growth that Page Industries has. Probably some of the other branded players have as well, but I'm just talking about Page right now, and that's the number that I have. So the runway for growth seems fairly large for Page, and which is why the way ahead becomes very, very important. Yes, it is expensive. It's trading at about 60 times FY20 EPS. That's not cheap. That's very, very expensive. But I think from every investor's perspective, it'll be important to estimate the runway or the length of the time for which Page can continue growing at 15-20%. If we assume, if in your assumptions you believe that Page could grow at 20% plus earnings growth for a period of the next 10 years, then there is no doubt that the returns will come in. It's just that the return will depend on the extent of the valuation contraction or expansion. But if the stock or if the business grows at 20%, and the valuations contract a little bit as well, you will still end up making 15% CAGR for the next 7, 8, 9, 10 years, depending on for how long does Page continue to grow at this rate. So it may be expensive, but the business is growing, and the management is showing no signs of any kind of warning about they having reached a bit of a plateau or a peak. So until the going is good, I don't know if it merits a fresh investment or no, and I'm no one to recommend that, but most people that we speak to say that if you have an investment in Page, it might be wise to stay invested. So that's as far as Page Industries goes. It's right there in the MSCI index for a reason. It's not what the stock has done over the last couple of years. It's probably what the company has done over the last 10 years, really. So that Page. Let's move on to the other pieces. The third piece on First Word today, a SEBI panel has recommended that the scope of consent mechanism be extended to cover other alleged offenses as well. A settlement allows the accused to pay a monetary penalty without admitting guilt. Confused? Well, Jashu Upadhyay has this report.
The panel headed by Justice A.R. Dave has recommended that SEBI widens the consent mechanism. As part of its proposals, the panel has suggested that SEBI allows cases of insider trading, front-running, mismanagement of financial statements to be settled via the consent mechanism. This comes with riders that SEBI needs to be satisfied that the alleged defaulter has made good on the losses and there is lack of market-wide impact. However, the committee has also recommended that repeat offenders, willful defaulters, and economic offenders should not be allowed to settle cases. One interesting recommendation is allowing confidentiality if one of the partners assists in the regulator in its investigation.
Well, Moving on, retail inflation registered its first moderation in 4 months to come in at 4.17% for the month of July. Higher tomato and onion prices in the same period last year expected to have cushioned the rise in food products, which came in at a 10-month low. No such luck for fuel, with rising crude prices taking the entire basket higher. A sharp rise in fuel can trigger an uptrend in inflation. The RBI, which recently hiked the interest rates for the second time this year, will also be more comfortable now that consumer prices are moving back towards that 4% target range. And therefore, the question marks will be out whether these numbers give the RBI the ammo to stay on the pause mode for the rest of the year. We've seen a couple of actions in the recent past already. Whether we enter a period of a pause for the rest of the calendar, that's the big question. Remember, we'll be talking about this to Sajid Chinoy a bit later on as well at 9:30. So it'll be interesting to hear out what he has to say on inflation, on growth numbers, on the IIP numbers, and of course, talk about the whole emerging market situation. But I think inflation will be a vital part of my conversation with Sajid Chinoy a bit later on. As would be the Turkish lira and what's happening around it. In fact, speaking of the Turkish lira and the fears of contagion, veteran emerging market investor Mark Mobius is not too concerned about the Turkish crisis. He believes that there are still pockets of opportunities in emerging markets. He spoke to Bloomberg Asia. Mobius said that he would avoid investing in heavily leveraged companies. Listen into a small slice of that conversation.
I think Turkey is a very small part of the index, regardless of what index you're looking at. So the good news is that the ETFs are not forced to sell down because of a decline in the Turkish market and the Turkish lira. So that's the good news. The bad news is that if Turkey is forced to close the foreign exchange window so that foreign investors cannot get out, that'll be very, very bad, and a bad example for other emerging markets if they're trying to try that going forward. As you know, in the past, during the Asian crisis, Malaysia did that, and it was very, very bad news. So this is something we have to watch very carefully. But the bottom line is that, this is bizarre politics. Erdogan and Trump are bargaining for this pastor. And, of course, Erdogan wants Trump to give up Gulen. And, this is the kind of bargaining that goes on. And I don't think Trump can give up on Brunson. And probably Erdogan is not going to give up on wanting to have Gulen back. So this is going to be a real standoff, I believe.
I'm curious as to whether you think that it's time to be opportunistic. If you take a look at the sell-off across other EMs that don't have the terrible external imbalances that Turkey has, is it time to get in, or are you cautious? Because, to be fair, even before Turkey really erupted, the fundamentals in terms of the trade war, the strong US dollar, were not favourable for that EM space.
Oh, there's no question there are opportunities in emerging markets now because of this incredible decline in the currencies. But we have to be very, very careful about which countries we want to invest in and which companies in particular. And, of course, leverage is all the story. We have to be careful not to be investing in companies that are heavily leveraged. By the way, this story about Tesla is really about the debt and about its ability to pay all of the debts it has. And with interest rates rising, you're going to have problems with many companies around the world, not only in emerging markets, but in developed markets. And that's true of the countries. Country debt with higher and higher interest rates in dollars is going to be a real problem for many of these countries.
Has Recep Tayyip Erdogan backed himself into a corner by saying that he's not going to take a bailout internationally, and secondly, he's not going to raise interest rates?
Well, this is the problem, and it seems to me that the only opening for him would be to give up on Gulen and return the Brinson, return the pastor to the U.S. That would be the best alternative for him. And you may see that happening. There may be a face-saving effort on both Trump's part and Erdogan's part. But it remains to be seen. I can't be too optimistic, let's put it that way.
And if you're a depositor in a Turkish bank, would you be taking the money out and putting it under your mattress?
I am a depositor in a Turkish bank, and I've got most of the money out, but I'm keeping some in because I think longer term Turkey is going to be an interesting market to be in. But if you've got Turkish lira, of course, you're losing. In my case, I have U.S. dollars and a little Turkish lira, so I'm in pretty good shape. But I'm concerned about any currency controls if I ever want to get that money out. Wouldn't be the near future, but anyway, this is something we would have to look at.
Well, that's all that we have on First Word for the day, but lots more lined up on Indian Open. Does the Turkish crisis complicate RBI's job of inflation targeting? We asked Sajid Chinha of JP Morgan that precise question. We turn to earnings, decode the June quarter results with R. Mukundan of Tata Chemicals and Rajesh Mukashi of Care Ratings. But after this break, it's a full tilt towards a very busy day of trade. Stay tuned to Bloomberg Quint Live.